Alrighty, guys, this is a demonstration of what you're going to be doing for chapter 1 exercises. Okay, so what you're going to do is you're going to go here into your chapter 1 exercise, and you're going to see everything. Notice that it's due. Actually, we start accepting submissions on Monday, May the 6th, but notice that it's due by May the 12th, again at 11:55. So what you're going to do is you're going to turn to your page, turn to your book, beginning on page 34, right? And then these are the exercises you're going to do. What I've done, though, is I've actually placed the spreadsheets for you to download onto your computer, and then you can PDF both of them, do the merge, and then PDF both of them and send them to me, okay? So let's first look at what you're going to be doing. Actually, the pages are on 29 and 31. Now remember, each spreadsheet is worth 50 points, okay? So completing one is 50 points. Completing the second one is 50 points. Now, I'm giving you 50 points. Let me tell you how I'm going to do that. I'm going to show you how to do the first one, okay, to help you along so that you understand what you're doing. So when you click on it, you're going to download. Notice what it's going to say. Open with Microsoft Word, and you're going to say OK. Now, once you click OK, you're going to see what comes up. It says Enable Editing. You need to click on Yes so that you can actually use it. Okay. Now, it'll say Slater, problem 1A. And you're going to be able to A5, and you're going to work with it. Okay. So what you're going to do is you're going to make sure. I'm sorry, I was going back and forth because I've already got one filled out for you. So what you're going to do is it shows first the balance sheet. You're going to click on the bottom. If you've never worked with Excel before, you're going to click on the bottom. Each one of this is called a sheet. You're going to go to A. Okay, click on A. When you click on A, you're going to see all this information that is here, and you're thinking, what am I supposed to do with that? Well, hold on and I'll show you. Okay, so first let's make sure that we're on the correct page in our book. All right, once you go to page 29, you're going to see at the bottom of the page, it talks about James Tanson, retired Army officer, opened Tanson's catering service as his accountant analyzed the transactions listed next and present them in proper form. So everything that they're going to ask you to do, you're going to put them here, okay? So and then you're going to do the analysis. You're then going to do a balance sheet, and you're going to do the statement for the month of October, okay? November, and the owner's equity and a balance sheet as well. So this is what we're going to do, all right? So I'm going to show you what we're going to need to do. Now remember, we're working with 2 months here. So notice that we start on the 25th of November. So you'll see that the book has it split up in two, where you'll see the transactions that happened, okay? So I'm having to go back and forth off camera, I'm sorry, but it was because of the fact that my book is over here and this is over here. Bear with me for just a little bit, okay? So on the 25th, notice what he says, okay? What it says is that James Tannins invested $20,000 in the catering business from his personal savings account. Okay, so he took money out of his personal account, started his own account, okay? So what we're going to do is we're going to think about which accounts are we going to be using. So he took money from his personal account, created a catering service bank account, and he's going to start by putting that money into cash. So what are you going to do on the 25th? It said that it due. So he put $20,000 in. So you're going to add $20,000, 1, 2, 3, in cash. Okay? So you're going to put the money in there. then notice that is the capital he's investing. So in order for everything to balance, when you're looking at two accounts, remember, because assets equal assets equal liabilities plus owner equity. So in order to make one side of the account equation correct, then you've got to put the other one in. So you're going to add the $20,000. Okay. Now, one thing that I'm going to caution you on is a lot of people don't like to bring their balances down when they're working with these. I'm going to caution you to make sure that you do bring your balances down. And the reason why is because if you don't, if there's another transaction, you could place it in the wrong area, and then you're not going to balance at the end. Okay? So the balance then here is $20,000 that we've got, and $20,000 for that transaction on October the 25th. Okay? So the next thing that he did, which is on October the 27th, and notice your spreadsheet already has it ready to rock. And it says, bought equipment for cash from Monroe Company for $2,300. He bought it. Now in accounting, as I stated before, it's going to be all about the verbiage, all about the words that are being used, the action that is taking place. So if he bought equipment, okay, that means that he didn't put it, it doesn't say that he bought it on account, which means he bought it right out from cash. So what would we do? Just like you would do in your checkbook. I know you guys use debit cards instead, but let's just consider it. You're going to take the money out of cash, okay? For how much? You're going to take it for $2,300. Now, when I put the parentheses in $2,300, in accounting terms, that means I've got to subtract the $2,300 from my accounts, from my cash account. But I'm not done yet. So where am I going to put it? If I take that out, I still have to put it somewhere. So again, I put it in equipment in that account to show that I have purchased equipment for $2,300. And let's do our balances. So again, $2,300 from the $20,000 that we've got is what? It's going to end up being the $17,700. But the balance for equipment is going to be what? $2,300. Oops. Now, again, do we do anything with accounts receivable? Nope. Do we do anything with accounts payable? Nope. Capital, do we do anything with it? Nope. Does it remain the same? Yes. Anything with withdrawals? Nope. Revenue? Nope. Expenses? Nope. Okay. Let's do one more, and then I'm going to show, and then I want you to continue, and let's see how you do. Okay. So the next one says, bought additional equipment on account from Ryan for $2,000. Okay. Bought equipment on account. Because we did it on account, we're not taking it out of cash. So, but we bought additional equipment. And remember what I said, it's all about the verbiage. So we bought additional equipment for how much? For $2,000. So equipment and on account, meaning accounts payable, because we owe somebody something, which is a liability. So we're going to add the $2,000 here in equipment, and then we're just going to put in also for the transaction of the $2,000 also in accounts payable, right? There we go. So now we add the $2,300 and the existing equipment account. So we end up with what? We end up with $4,300 balanced. Now, don't get freaked out. Doesn't matter that this is the 43 and this is still the balance of 2,000. Don't get bent out of shape with that. the equation, the transaction is what has to balance. Okay? It must balance out. $2,000, $2,000. Did we do anything in for cash? Nope. Did we do anything for accounts receivable? Nope. Did we do anything for capital? Nope. Cancel withdrawals? Nope. Revenue? Nope. Expenses? Nope. But we still bring down all the balances as well. So we still have the $1,700 that we have there, right? Oops. 17,000, excuse me, $700. That's still there. That's there. We still have the $20,000 in capital that we've invested. It's a historical account, so we continue to bring it down, okay? Now, I've shown you several things that you're going to need to do. So that's bought additional equipment. Now we're going to show about how we pay something. And then I'm going to want you to do November on your own, okay? So it says that we paid, what was it, $900 for partial payment on the equipment. So we paid, meaning we took money out of our account on the 29th, which was $900. So 900, there we go. Out of what? Accounts payable. So what do? You subtract what we owe by $900, okay? And the balance then here is going to be $16,800. Didn't do anything here. Didn't do anything here. We still have the equipment. But here, now we're going to subtract that as well. And now we only show a balance of $1,100 for accounts payable because we paid partial payment. Okay? Partial, not the whole thing. Our historical account stays at $20,000. Nothing here, and nothing there. Okay? Now, work on this, okay, and then continue the video, and I'll show you everything that you should have at the end. Okay? Okay, so I didn't pause it. You saw everything that I did. Sorry. I'm not infallible, as I told you before. I'll make mistakes. So anyway, here we go. I've made this a little bit bigger so that you can see it. Hopefully it makes it bigger for you. So this is where we were all the way up to our balances for October. Then we had some things that we did in November. In November, let's see, let me bring the book back so that we can see it and you can see what ended up happening. So for November, we actually catered a graduation. So because we catered a graduation for $1,300, we brought money in. And notice what we did, we put it in revenue, okay? Because that's the money coming in. So we say that it's revenue, but we put it in our cash account. So we have to remember how much money we made throughout the month. Apparently we didn't do very much in October. So now our balances, of course, then come up to $1,800. All the balances remain, and we now have a new balance in catering and revenue. Then on the 5th, we paid salaries for $800. So we take money out of our account and we pay it. We place it in expenses. However, remember that each expense is going to be individualized. So you will see this in the balance sheets and the net income, owner's equity. You're going to see this as a salary expense, okay? But for here, it's just an expense. Then on the 8th, we prepared desserts for customers on account. On account, okay? On account of $500. So you're going to see that if it's still on account, but we didn't get the money in, but it's still considered revenue. So we go ahead and we place it as we got revenue, but they owe us. So it's considered accounts receivable because they haven't paid us yet. So we show it here in accounts receivable, making sure that people understand they still owe us money. Okay. Then we bring our balances down again. So on the 10th, notice what happens. Okay. On the 10th, these people that owed us money for the catering that we did for the desserts, they gave us half of the money. So you would put half in cash, and then of course their balance is $250 because they still owe us the amount. Still, okay. So they only owe us $250 now. So we bring down our balances. This should have been $250. Why I didn't put it there, I don't know. I put it in the other one. So there we go. Now, we also took $400 out for the bill, telephone bill. Here you see the expense, okay? So now we have salaries and telephone bill. So now we have a balance of $1,200 as far as our expense account. And then here we take out the $400 and we have a new balance for our cash. On the 17th, $160 he paid his home electric bill. Okay, now it's a little different. Even though it's an expense, it's not a company expense. Notice that it says that he paid his home bill from the company checkbook. So we still take it out of cash, but instead of labeling it as an expense, we show it instead as a withdrawal. He withdrew money from the company for his own personal use, and that's why it shows it that way. Okay, all right. Then we did some more revenue. We went ahead and we catered a wedding, so we got the catered of the wedding, and we added it to the money that we have in cash. We bring down all our balances again. Then now, he bought additional equipment on account that we've done before. So you add the $1,200 to the account. Then, of course, you add it now to accounts payable. So now our new balance, even though we had paid some off, now we have $2,300 there. So we bring all our balances down again. Okay? And the revenue is $3,600 now. So then on the 28th, we have now the rent that is due. Now it says that it's rent was due but unpaid. Unpaid. You still mark it down as an expense for the month, but that it's unpaid. So it is a liability that we still have to pay in the future. And it goes into expenses because it's part of the business expenses. Okay? Then he also has a supply expense that he paid out. But this time it says that we paid it out. So here we go, taking money out of cash and placing it on our expense account or the accounts for expense. When everything is said and done, these are the balances that you should have for each one of the accounts. Okay? Now remember, it said that it wanted you to do 2 balance sheets, one for October and one for November. So we take everything that happened in October, create the balance sheet. Like, I don't understand. Yes, you do. Okay? Remember, I told you that the balance sheets could be found on page 8 so that you could see it. And then, of course, you can also see the other formats as well throughout the book for owner's equity and income statement on page 20. Okay, so here we go. So balance sheet. Balance sheet has cash, Okay, the balance for cash at the end of October. Here, 29th. So what do we have? Boom. Balances for equipment for the 29th. Liabilities, how much we had in accounts payable. Okay, how much owner's equity we had, taking the balance that was there. So we have the total assets of $2,100. And then our liability plus owner's equity, boom, $2,100. It balances. Okay? Notice again, here we go. Assets equal liabilities plus owner's equity. Then we have the income statement. Okay, but the income statement is for November, right? So we're taking the revenue that we made, which was $3,600. Again, ma'am, where are you getting that balance? Here we go. Right here for November, the 30th. Ending balance, $3,600. Not making this up, guys. So $3,600. The expenses. We go back, we find out how much each expense was, the balance for them, and then we total them up. Now here what you're doing, you remember in the income statement, you're taking revenue minus the expenses that you have. So now you have net income. How much money did I really make? I didn't make $3,600. After I paid my expenses, I only made $1,450. Wow. Okay. Then I have to create my owner's equity. Remember, owner's equity is always going to have the historical amount unless he added more, which he didn't. We take the net income for November, from the sheet before, right here, place it in. Now, less any withdrawals, less any money that he took out. Well, he did. He took out $160 for his own personal use. So what do? You minus that. So now the increase in capital or the right that he has is $1,290. It decreases his net income. But see, because he's still on the positive side, it increases his capital. Okay? So it did increase it because he made money. So he has the right to all of that. He also has the right to pay all of it if it defaults. Okay? The next thing that we have then, of course, is the balance sheet for November. Again, taking all of the balances at the end of the month on the 30th of November, placing them where they're supposed to be. Again, all the assets, he had cash, he had accounts receivable, he has equipment. So his total assets are $24,240. Liabilities, he has accounts payable and what he still owes. This capital, we take it from his owner's equity right here, put it in. Total liabilities owner's equity equals $24,240. Boom. Again, everything balances out. So this is the first one. This is what you're supposed to do. Okay. You need to do the second portion, which is going to be problem 1B5, which is similar to this of what we just did, some of the transactions. And then what you need to do is make sure that you view this on how to merge them together, and then go back and figure, and also have a video on how to make sure that they're PDF'd, being able to be PDF'd, and then doing your PDF merge in the same video, right? If you have any questions, don't hesitate to email me, contact me, text me, whatever it takes. I'll see you guys on the flip side.